Welcome to Morning Markets. It is all about jobs, as I mentioned, on both sides of the border and what it means, A, for the markets and B, for the path of interest rates in this country and in the United States. Joining me to unpack all of this, we've got Gennadiy, chief economist and strategist at Desjardins, Gennadiy Goldberg of TD Securities, and Tom Essaye, president of Sevens Report Research. Jimmy, I'll start with you if I can. While both Canada and the U.S. added more jobs than expected for the month of September, you can certainly quibble with the details and the quality. Maybe we'll start with Canada. Was this a perfect job numbers, or are there signs that maybe the job market is not as robust as the headline suggests?
No, exactly. It's not necessarily that big of a number because it's heavily influenced by some choppiness in the educational sector. The timing of back to school is always complicated for this seasonal adjustment by Statistics Canada. So we have to look through that. And when you look elsewhere, what you see is that job creation was in fact slightly negative. So the bulk of job creation really was in part-time jobs. And we actually saw a contraction in hours worked for the second time this year. So not a very strong report when you look at some of those internals. The participation rate went up. And of course, working age population growth remains pretty strong overall. So the labor force had a pretty strong month. And that's why even with all those jobs created, you're not seeing the unemployment rate go down. So for the Bank of Canada, there's only one blemish, I think, in this report, which is the fact that wage pressures actually re-accelerated.
So ultimately, we did see pricing, Jimmy, of rate expectations in Canada go up for the October meeting. Do you feel like the risk is tilted towards another rate hike?
Well, I think we have to remember that, up until, recently, higher for longer was nothing more than a good slogan for a cannabis company. Look, markets used to be pricing in rate cuts to come in short order the moment the Bank of Canada would decide to pause interest rates. Now, they're seeing scope for potentially a bit more tightening. But really the length of the pause in interest rates that's now being baked in at those very high levels, that would be unprecedented if it were to materialize. And certainly in Canada's case, there's no question that it would be exceptional for the Bank of Canada to hold that long, especially at current debt levels, and also their desire not to put undue pressure on financial stability. So I think ultimately it's going to be the path of inflation that will hold the answer. But my view on higher for longer is, the higher we go, the faster we fall.
Gennadiy, I'd love for you to maybe pick up on that point and include what we saw from the U.S. jobs picture, because I've seen some reference to, yes, it was blockbuster, over 300,000 jobs created, but the household survey certainly painted a different picture. Full-time employment has been struggling now for 3 months.
Certainly. So you've certainly had some issues with temporary employment coming in a little bit lower. Overall, though, I mean, it's a little bit hard to push back too much on this jobs number. It is quite, I would say, blockbuster at this point. And what you've seen is a lot of upward revisions to prior months. And I think this is really the tricky part. For the central bankers. How are they meant to make monetary policy when the 3-month average rate of payroll growth went from 150K and after revisions of about 120K to the last couple of months went up well past 200 to about 260. So we're seeing very choppy data here. And I think the Fed has to look at more than just the payroll number to get a sense of what the economy is doing. And as you mentioned, obviously, the unemployment rate is staying higher at 3.8. You're seeing a little bit difference on the household side of the employment. So I think they need to see more data. They're not going to be in a rush here.
The bond market is reacting. The reaction is swift. We're now at 4.8 on the U.S. 10-year. How much higher does it go?
Well, I think this payroll print makes a move towards the 5% mark, or at least a test of the 5% mark, fairly inevitable here. What I'm really watching in the next couple of weeks is the tone of FOMC remarks, certainly more data, and CPI. If CPI, goodness forbid, comes in a little bit higher than expected, the Fed sounds a little bit more open to potentially delivering another hike in November or December, you could certainly see the market really make a run for 5% and maybe a little bit higher. The big question for us is, does that break anything in markets? Does that put more pressure on the banking system, on the corporate finance system? And at what point that really starts to pressure consumers and companies lower?
Tom, you think about portfolio strategy, putting all of this macro data into practice when it comes to the stocks that you're going to buy. Pick up on Gennadi's point. Does this start to break things?
Yes, I think eventually, but I think the U.S. economy is still stronger than people really expect. And I think from a market standpoint, really what investors need to think about is it's not so much whether the Fed hikes once more in 2023. I mean, the 25 basis points after what we've done isn't that big of a deal. The bigger issue is where market expectations are on future rates. So if you look at Fed fund futures, the market still expects the Fed funds rate at the end of next year to be around 4.6%. The Fed is telling us that it's actually going to be more like 5.1%. And that's the gap we have to watch. That gap has to close one way or the other. If it closes by rates going up, which is what we've seen over the past couple of weeks, stocks will continue to decline. And I think eventually the Fed does slow the economy, but it just has so much momentum right now. I don't think it's happening anytime soon.
And we've talked to you in the past about you've got this sort of soft landing scorecard, and it feels like we're cheerleading for a soft landing. But wouldn't a soft landing, Tom, be bad for assets? Wouldn't it be bad for stocks? Because if we're in a soft landing, it does mean that we are higher for longer.
Yeah, I think that the soft landing, it depends how soft it is, right? And that's where we get into the nuance. I think if you see growth slow, like let's just use GDP growth, right? If it goes down to like 2% to 1% for a few quarters, and we call that a soft landing, and the Fed can then begin to cut rates because inflation has declined, hey, that's great, right? It may not send the S&P 500 and Canadian stocks 20% higher from here, but we're not going to give back a lot of these gains. The biggest worry is that all of a sudden we get blindsided by a growth scare, and that all of a sudden something starts to break, and people get very nervous, the Fed and the BOC and everybody else has gone much too far, much too fast, and now it's too late. That's the biggest issue for this market over the longer term.
Of course, one of the areas that we have seen benefit from all of this consternation has been the U.S. dollar. Jimmy John, how is that going to affect and complicate Canada's battle when it comes to inflation? Could it be the U.S. dollar that starts to break things around the world?
Well, certainly we've seen the Canadian dollar being weak as the resulting from that strength in the U.S. dollar. That's something that we actually have been expecting. I think it's only a small part of the overall calculus. I think the Bank of Canada is much more concerned with, domestic price pressures. But, at the same time, you are seeing some signs of weakening in the economy. I mean, regardless of the numbers today, you're seeing better labor availability. The number of job searchers is up 14% since the beginning of the year. And, I think in that context, given that we're still bringing in a lot of people into the country at a fast clip, the unemployment rate is being pressured higher. In other words, demographic growth is raising the bar for the level of job creation that keeps the unemployment rate from rising. Again, 65,000 jobs added, but little movement in the unemployment rate. We know that job vacancies are not far from normal. And at that point, we could see more slack, and that could actually solve the current wage problem. So, yes, I think, in the big picture, you still have some evidence that the economy, at least here in Canada, I agree, in the U.S., it's not clear cut. It's not even there. The signs of cracks are very few, absent maybe the housing market. But here in Canada, it's becoming a fuller picture. And for those reasons, I think the Bank of Canada has enough arguments to, while contemplating the entertaining rate hikes if needed, but actually stay on hold for a number of months here.
And of course, one of the, I mentioned the bond market. We are seeing those yields at 4.8%. Gennadiy, have you looked at other signs within the bond market of these cracks? I know the high yield market, for example, has pulled back, but it hasn't been, a significant drop. It's what you might expect if we are repricing to this higher for longer environment. What does that tell you about, the outlook from bond investors?
Well, I think it really tells us that bond investors are sort of starting to capitulate, and maybe bond issuers are starting to capitulate as well. I mean, one of the big things in the high yield market, for example, is the lack of issuance that we've seen so far this year. The volumes have been quite low. Why is that? Well, companies are waiting until rates actually go back down to try to issue. If they realize that rates are going to stay high for a very long time, it's going to be very hard for them to play that waiting game, and inevitably they'll have to come in and issue, and that's going to put some downward pressure on their ability to repay, and that could trigger some worries. I do think the key here is obviously just how high we stay and for how long. Even if we stay here, and the point was made earlier about basically the low point of the Fed cycle, and that's something we've been tracking, that trough rate, basically the point at which the Fed actually stops cutting rates. That's gone up to about 4.2% over the last couple of months. It was at 3.3 just a couple of months ago. So already the market's expecting higher for longer. And if that trend continues, a lot of these companies are going to have to come in and actually start to finance themselves at these very prohibitive levels. And then it could really start to put some downward pressure on earnings and some downward pressure on the economy as a whole.
We are going to get a sense of that earnings picture in a few weeks. And right now, expectations for 2024 are for profit growth. Tom, last word to you, your highest conviction area of the market to hang out in right now?
I think you need to stay defensive and have quality cash flows. You're going to see some volatility as yields rise and some investors rotate out of things like utilities, consumer staples, healthcare. But I think that if your main worry is that the economy does start to slow in the next several months, and that is my worry, then I think that defensives over the next 6 to 12 months can continue to outperform. It's going to be a bumpy ride in everything, though.
All right, gentlemen, thank you.